It usually begins with hesitation. Someone has saved a meaningful amount of money. They've read about investing. They understand markets tend to rise over long periods. But there's one question they can't shake. What if I invest and the market crashes tomorrow? So they wait. They watch headlines, inflation numbers, central bank meetings, election cycles, recession warnings, market rallies, market pullbacks. Weeks turn into months, months into years, and the money sits still. This is where dollar cost averaging enters the conversation, not as a trick, not as a guarantee, but as a structured response to uncertainty. Let's begin simply. Dollar cost averaging is the practice of investing a fixed amount of money at regular intervals, regardless of market conditions. Instead of investing $12,000 all at once, you invest $1,000 per month for 12 months. No prediction, no timing, no emotional adjustment, just consistency. On the surface, it seems almost too basic to matter. But behind that simplicity is an important behavioral and mathematical logic. Imagine two investors. Investor A invests $12,000 today in a broad market index. Investor B invests $1,000 per month over the next 12 months. If markets rise steadily during that year, Investor A will likely end up with more money. Why? Because more capital was exposed to growth earlier. Markets, historically, trend upward over long periods. Time in the market generally beats timing the market. But markets don't move in straight lines. If the market declines shortly after Investor A invests, the emotional pressure intensifies. A 15% drop feels personal when it happens immediately after committing capital. Some investors panic. Some sell. Some abandon their strategy entirely. Investor B, meanwhile, continues investing monthly. When prices fall, that same $1,000 buys more shares. When prices rise, it buys fewer. Over time, this averages out the purchase price. This is the mechanical advantage of dollar cost averaging. It reduces the risk of committing all capital at a temporary peak. But the deeper advantage is psychological. Behavioral finance has repeatedly shown that investors struggle most with volatility right after large decisions. Loss aversion, the tendency to feel losses more intensely than gains, can lead to reactive decisions. A single, poorly timed lump sum investment can derail long-term discipline. Dollar cost averaging smooths the emotional entry point. It transforms investing from a single high-stakes event into a system. Now, let's address an important truth. From a purely statistical standpoint, if you already have a lump sum available, investing it immediately has historically produced higher expected returns than spreading it out. This is because markets, over decades, have risen more often than they have fallen. Delaying exposure can mean missing gains. So if lump sum investing has higher expected returns, why does dollar cost averaging remain so popular? Because expected return and investor behavior are not the same thing. An optimal mathematical strategy fails if the investor cannot stick with it. Dollar cost averaging acknowledges that markets are uncertain in the short term. No one knows whether next month brings expansion or contraction, central bank tightening or easing, geopolitical stability or disruption. Consider history. In 2008, global markets fell sharply during the financial crisis. Investors who invested gradually throughout 2008 experienced declines, yes, but they also accumulated shares at significantly lower prices. When markets recovered in the following years, those lower-cost shares amplified long-term returns. Similarly, during the sharp decline in early 2020 at the onset of the pandemic, investors who maintained systematic investments purchased equities at discounted valuations before one of the fastest recoveries in history. Dollar cost averaging does not eliminate losses during downturns. It distributes exposure across different price levels. There's another layer, income structure. For most people, investing doesn't involve large windfalls. It involves monthly paychecks. Retirement accounts in the US, like 401ks, or workplace pensions in Europe, naturally operate on a dollar cost averaging basis. Contributions occur automatically with each pay period. This structure aligns with how most people earn money. Over decades, this steady investment pattern has allowed ordinary earners to accumulate substantial wealth, not by predicting cycles, but by participating consistently. But there are risks and limitations. If markets rise sharply and continuously, spreading out investments may reduce potential gains compared to investing everything immediately. If an investor becomes overly rigid, continuing to invest without regard to extreme valuation environments, it may not always be optimal. And dollar cost averaging does not protect against prolonged bear markets. If markets decline over several years, systematic investments will still face temporary losses. It is not a shield against volatility. It is a framework for managing entry risk and emotional stress. There's also a misunderstanding worth addressing. Some believe dollar cost averaging guarantees a lower average price. It does not. If markets trend upward, your average cost will also trend upward. The strategy reduces timing risk. It does not promise bargains. The real question is not whether dollar cost averaging beats lump sum investing in every scenario. The real question is, which approach aligns with your temperament and financial structure? If you receive a significant inheritance or bonus and feel comfortable with volatility, immediate investment may align with historical probability. If you feel anxious about short-term swings, spreading investments over time may help you remain disciplined. And discipline, over decades, often matters more than entry precision. Markets reward participation, but they also test conviction. Dollar cost averaging shifts the focus away from prediction and toward process. It says, I don't know what markets will do next month, but I know I want to participate over the next 20 years. It transforms investing from a question, is now the right time, into a commitment, I will invest regularly regardless of headlines. In a world dominated by forecasts, alerts, and volatility charts, that quiet consistency can feel almost radical. So perhaps the deeper insight is this. Is your investment strategy built around predicting the perfect moment, or around building a system that works across imperfect moments? Because markets will never offer certainty, but they do reward structure. And the difference between hesitation and participation often compounds more than timing ever will. This is Finance Guru, where we don't chase noise, we study reality.